Excellent. Take it away, Robert.
Yes, hello. Welcome to our webinar today. A very new, interesting topic, especially it reminds me of my time as a fund manager, the Institutional Trader series. Well, starting today with myself, with Rother, a hedge fund manager. I will tell you more about myself later. Tomorrow with Spencer Regal, also a hedge fund manager. Tuesday at 4 p.m. with Brad Gilbert. And on Wednesday with Marco Bösing. And on Thursday with Scott Pulcini. And on Friday with El Vinjamur, if I said this correctly. Well, most importantly, as you know, the general disclosure, all Bookmap Limited materials, information and presentations are for educational purposes only and should not be considered specific investment advice nor recommendations. Risk disclosure, trading futures, equities and digital currencies involve substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. So, on the October 29th, a very special event is starting, Trading Scary Size from Bookmap. And well, you're going to get $1 million to trade. And then, of course, you have to think differently as a trader. We cannot use the common way of trading. And I want to share some of my experiences about how I managed my fund and how I managed to trade with some larger amounts of money. You can find more information here on competition.bookmap.com and register there. And I think it will be a great, interesting new event. And then, of course, news. People from my community, you already know it. There are interesting beta functionalities from Bookmap, like the multi-account trading tool. That is very nice. And if you want to get access to these add-ons, you simply send an email to beta@bookmap.com and, well, start to upgrade on the new Bookmap version and get a preview into the new functions. I'm using them already and I'm very satisfied, especially with the multi-account trading add-on. To trade, easier through many accounts. Then, of course, Blue Jacket competition, starting on the October 10th. Last winner was also Laura, a member of my community. I'm proud of that we can bring the people to a new level. And of course, Thursdays at market close is a Bookmap Academy. I believe it's one of the best resources to get to know Bookmap and to trade with the heat map and get into the deep dive of day trading. So today, the Institutional Trader series is starting with my person. Well, it's in Discord only, as you can see, and now I can see more and more people are actually joining us. That's nice. So we keep it a little bit slower with the pace. I think the tour together today will be around 1 hour. Longer or not. Let's see. My name is Robert Rother. I had 2 investment firms. I started trading at the age of 13. And I set up my first investment firm in Frankfurt, Germany, with 2 partners together. And they were actually also my mentors of how to manage funds, how to trade managed accounts, how to set up hedge funds. And while we were at that time still trading directly to Chicago Mercantile Exchange through the telephone. And well, from them I actually I learned to this business. I sold my shares in that company a couple years later, and then I moved to China, where I set up a second investment company with a Chinese partner together. And at the peak time, I managed over $100 million under management, and I had a team of 30 traders and analysts in my investment firm in Shenzhen, China. Shenzhen basically is with Shanghai together the financial hub in China, and they have, well, it's at the border to Hong Kong, and they have, with Shanghai, Shenzhen Stock Exchange and Hong Kong Stock Exchange, basically the center of the Chinese financial markets together. I was trading with my team Chinese stocks a lot, of course, since we were in China, and I trade the Hang Seng Index future, and of course, during that time, always the ES, and crude oil and gold were my primary markets. But the biggest problem, if you manage a larger amount of money and you have to know how to enter the market, especially in stocks, for example, if a stock only has a daily trading volume of, let's say, 50,000 shares, but your fund has to buy like 100,000 or 200,000 shares, you have to think completely differently to find a way to put your position into the market. Otherwise, you're going to pay a lot too much for these shares. Well, and if you're quite successful in China, then I believe some people of you already know my story. I was detained in May 2011 for outsmarting the Chinese finance system. And one part of this was also a website that I had called Finance China, fnchn.com at that time, and I was controlling the Chinese financial stock market information in English language. That was unique at that time. And of course, my idea was simply who controls the news controls also the money flow. If you want to bring larger amounts of money into the market and build up your position size, then, well, if you control the news, you definitely have an advantage. It's also part of that story, how to trade with a lot bigger amounts of money. I was released in December 2018 after 7 years and 7 months in a Chinese detention center and Chinese prison in Dongguan. And in the first year after my release, I wrote a book. It became a best-selling book in Germany. We are working on an English translation that it's getting republished, and you can learn about my life, my crazy life that I had. And right now, running 2 trading communities, basically focusing on prop firm trading. And we are having every day our live trades, and I'm funding one Apex account and getting payouts from Apex regularly. And also, I will also give at the end a little outlook onto the development of prop firms. And if you trade like 20 accounts, then you also get into this sort of problem where you really have, if you're trading live, have to learn how to manage your position sizes. So then we finish the presentation, and well, let me tell you some certain things. And Bruce, if you have any questions, just jump in, or if there are any questions here in the community, I'm happy to answer them. I always try to keep it very interactive, not like a monologue from my side. So if you have anything that you would like to know, or if you do not understand, just jump in. I can deal with that. So to understand liquidity, I think if you really want to trade with larger position size, the first thing that you always have to keep in mind, as larger the position size is that you're going to trade, as longer the time frame should be. For example, right now I'm more or less a scalper in day trading, and my trades only take like 10 seconds, 15 seconds, or a minute. With the position size that I'm using right now, I can trade this easily. But if my position size would increase 10 times or even 20 times from the size that I'm trading right now, I could not trade in this short time frame anymore. So I have to think differently. And the first rule that I always learned is, as bigger the position size, as longer your trade should be. Because over time, you can add and bring more order size into the market, and the market can actually absorb it. If I wanted to trade now like 1,000 lots, I would have a very bad execution. But if I divide this 10,000 or 1,000 lots in like 100 trades for 10, with a lot size of 10, you can actually enter the market at a fair price. I believe many people already heard this volume profile and point of control, these sort of technical analysis things. If we just jump in here, for example, on a different chart, that you see where if we have here just this fixed range volume profile, just as an example, it's an important tool. We can see how many lots were traded at a special price level. And this red line is the point of control. It means most of the contracts were actually executed at this price level. And this information as a trader is for me very important if I want to bring large positions into the market. So I have to know where are these point of controls. Because somehow the players at the market will think, okay, this is a fair value price. And then the market is going to stop there and people are executing their orders. So I can get easily a larger position size into the market at around these levels without risking a big slippage. We can also see here in Bookmap the SVP, the session volume profile on our chart to get an idea where is most of the liquidity. And we can see it is here at this level of 5,901 right now here. Yeah. But of course, if I trade on a longer time frame, I also need longer data history. Then the next thing is, and we can also have some examples here, very important for me. On this, you have to understand for every market, and also for certain periods of the year. It's not always the same, but we have here the current order book, COB, current order book on Bookmap, and we can see how many contracts are actually listed on the bid and the ask side. The green levels are simply the buy limit orders, the red ones are the sell limit orders. And I can see how large is this number. We are jumping here very fast, but we can see it's basically only like 2 digits. This is a very choppy market, how we call it. So if I simply want to enter now with 100, 200 or more lots, I'm going to move the market to the upside. So I'm going to have slippage. And this is something, if you participate at the trader competition on the 29th of October, you will see. If you want to enter a market, you will not get your execution simply here. The market will probably get 3-4 ticks to the upside or to the downside. This we call slippage. And this you also have to implement in your trading plan. Like for me, if I'm using a very tight stop, I'm mostly only using like 7, 8, 9 ticks. That's it. I could not trade this way because mostly my slippage would already be 4, 5, 6 ticks. So if I get in, I probably would already be out of the market because my trading style does not allow this position size. That means I have to rethink and to adjust my take profits and my stop loss. But I believe you're going to experience this very fast according to your trading style on the 29th. So the next thing is, if you look at this order book, we have 2 digits and it's already the regular trading hours. This is not always the same. If we look now at pre-session trading, many people are here from Europe or Australia, they will see that this market is even thinner. So if I want to trade larger position size during pre-session, I will get a bigger slippage. I will get bigger trouble to actually bring my position size into the market. So now if you trade larger positions, always consider when are you trading. And the two best time frames to trade larger position size, and we can see it at the volume, is simply at market opening, regular trading hours starting at 9:30 a.m. Eastern time, and market close. If we look at a simple chart, we can see that we always have the biggest volume spikes there. So if you want to get large volume with a little or less slippage into the market, check which time frames are most suitable for your volume. So this number but can also change, and if you follow this order book very well, you know 2 digits is a very tight market, but sometimes we also have 3 digits, that between bid and ask there are like 150 contracts to 150 contracts, so it's very balanced with triple digits. And then you can also again use smaller stop loss and smaller take profits for yourself because the market has not that volatility and not fear. The best and easiest indicator for this is actually here. If we look at the volatility index, and we can see in the past we were trading long time at a volatility at around 12 or 13. That means on the order book on the other side we have 3 digits and not 2 digits. It makes the market slower. You do not have this choppiness and sometimes easier to trade, but also a little bit boring because the market is not so fast. But it's definitely better to trade with larger position size when the volatility index is in that range, 12, 13, 14. If the VIX goes above 20 or even much higher, what we could see at this Japan crash, the market becomes definitely choppier and you only have 2 digits in your order book. And then you have to really rethink about your trading, take profits and stop loss, and also the time period of your trades. You cannot trade that short term, then you will definitely lose money and you're in trouble. So that is for my personal trading, and who's following me in my community knows this. These are the basic things that I look at. What is the current order book size? 2 digits, 3 digits. Where is the VIX? At which level is the VIX? And then I can determine how I am going to trade. And this is going to change, yeah, from period to period. For example, May, June, this time we had a very low volatility and we could trade it differently than since the crisis in Israel, Iran, and so on. Since a couple of weeks, there's a lot more fear in the market. We see choppier markets, and definitely you have to be careful trading with larger position size. The next thing that is very important for me to watch before I start trading, and especially when I want to trade with larger position size, is where is the liquidity here in the order book. Well, we got this auto spreader here in the ES, which is sort of annoying. Yeah, it's basically, yeah, disturbing the view on the heat map. But for this, we have the trader map light here on Bookmap, and then we can filter this auto spreader and get a clear picture on the market situation. If we look at this picture, for example, here we have at 5,910 larger liquidity in the market than on the other levels. Basically, also here is like three digits trading levels. So if I want to get into the market without having a big slippage, I have to basically look at these levels. Let's say I want to liquidate my position, I would look for these levels, and I know, okay, if I want to go long over a long time period, I would try to get my long positions here because I know I'm getting filled quickly. I have at least a player. If I want to buy 100 lots, I need someone who's also going to sell 100 lots. Yeah, so you have to view at these sort of areas which are interesting. As a long-term trader, if you're really a scalper, then probably you would think differently. But if I want to enter with large position size, these are points of interest for me. This is why we always say the market is going to this sort of liquidity zones. People are interested to make larger trades in this area. I'm going to check this during the day a couple times. Like we can see, we have larger liquidity here, but this liquidity disappeared. For me, it's a picture to know, okay, what is going to happen? Why did someone place a buy limit order here, took the buy limit order out? Why is there still a sell limit order here for a long time? Or is it just more like this, like a short, I wouldn't say spoof, but somehow somebody wanted to attract some algorithms, for example, that they actually detect these sort of liquidity so the prices can go to that area and they can find the counterpart. As I was trading Chinese stocks a lot, and Hong Kong stocks, the liquidity was definitely not as big as in futures markets. Yeah, we have to say it's a very low liquidity. But we also had a good trading opportunities. So what we were basically doing, we were detecting when, what is a chart analysis? Yeah, we have the traditional common trading knowledge. And then we have buy signals, sell signals, support zones, resistance zones, and so on. So when a lot of traders in the common trading industry following certain newsletters or trading styles like pivot points, Fibonacci, or just anything, yeah, crossing of moving averages, then we know that people are coming into the market. Well, and what I'm doing is I'm doing simply the opposite. Because then I know I'm getting my position filled without having a large slippage. Or probably I even get the slippage on the positive side for me because I know probably there's a stop run. This can happen, and I'm just taking the opposite. If this is according to my trading plan and I think that this is a fair entry price for my position, always have to put this into consideration. For us, it's important to see where can I get filled without that no one is going to detect it. Yeah, that's also another thing. We are coming to this topic here right now, as I wanted to say this. If you have larger position sizes, you do not want that the opposite knows who you are. Every order has a trading ID. And everyone can basically retrace this sort of trading ID if you're a larger player. And then you know, okay, Morgan Stanley is buying here, Goldman Sachs is selling here, yeah? So you come in sort of trap situations where people can use this against you. So you try to hide your orders. For example, here with Iceberg Orders, which are not displayed in the current order book. We can detect them, yeah? But once the orders are here in the market, normal people or normal traders on the order book cannot see it. So you don't know how much or what is the position size here that someone is going to sell on the sell limit Iceberg Orders. So you can actually hide your trades. And well, many big institutions and many traders are doing this simply to not get the exposure on the order book, but so they can get filled without that big players are noticing it. If you look very careful on a chart picture, well, you can actually recognize this with a lot of training, but to see it here with these blue lines, it's quite simple to know what these Iceberg Orders are doing. For me, as a big trader or a larger trader, if I want to make larger swings, this is a very interesting scenario. Normally, if you see a blue line, it does not give you a sell or buy interpretation. Just for me, what I can see is we have many blue lines above the price level. So that means these are sell limit buy orders. And we're not only seeing one, we're seeing 1, 2, 3, 4, 5, and probably more. There are nice pictures. If you see many of these Iceberg Orders on one level, most likely the price is going down, yeah, to a lower point of the day, because people are positioning themselves here. There could be two ways. We do not know what the way is. The first way is people are building up short positions. So they expect lower prices because these are sell limit orders, or people liquidating their long positions. So that means this level also reached a price level where people think, okay, this might be too expensive, overvalued, so I liquidate my long positions. Either way, the market most likely is going to make a drop. The big question is, when is the market going to have this drop? I don't know. But if I want to trade larger position size, I would simply try to add positions to my portfolio. Like I would always try to find like short 20 contracts, 20, 20, 20, yeah, in anticipation that the market probably goes down to VWAP. And then I have a fair level to actually liquidate my position. So these are signs for me on the long run where to trade and where not to trade. There is not much information out there, yeah, how this big money is working. Yeah. One case study that I found a long time ago is basically from Coinbase. And this actually also is giving you some insights why I am using VWAP and how certain orders are executed. I can also share the link later. Basically, this is from June 2020, where Coinbase tried to bought around $250 million in Bitcoin. Yeah, they worked together with MicroStrategy worked together with Coinbase as their executor, and they also tell you exactly how they did it. Yeah, smart order routing. So basically, it's all nowadays. It's going to be done through algorithmic trading to get a fair value and to hide your price. What they're using is basically the time-weighted average price. It's similar to the volume-weighted average price, but this is basically a benchmark to give you a fair price value. And they also wrote that they executed more than 200,000 child fills with less than 0.3 BTC. So if they want to enter with big amounts, they're cutting it down into child fills. Yeah. Normal human being cannot do that anymore. At least I would be surprised if you can execute like 200,000 orders in a very short time. Then you are very, very busy. But if I am also a larger order size trader, I have to know this information. So what is experience, or what is basically where is big volume be found? For example, around VWAP. There we can always have some sort of average or benchmark for a fair price. So if I want to enter a market, I also orientate myself according to VWAP, because I know big orders or a lot of orders chopped down in child fills are being executed at that price level. And then we have the VWAP, we have the standard deviations that give us a signature of, okay, there might something going on. And now we can also see here again, we had this liquidity disappeared, and now is coming back again, 97, just below here the VWAP. So someone probably believes that I can get a good fill here around this area. So we know people are playing here. And this is also around the point of control. These are areas where you can enter with big position size at a fair price. But then, of course, you have to know when you want to get out. What is your next big trading plan? Well, according to which sort of trading style you trade. If you are a day swing trader, that is everything, up to you into your trading strategy. So now I'm going to make a short break. Maybe there are some questions, and I'm waiting for your questions, and then I will answer them, whatever you like, about markets, about certain things which are maybe not that clear. And then I'm going to continue.
Oh, all right. This is really great stuff. Thank you, Robert. Thank you very much. Very, very nicely put. I have all sorts of questions here. And maybe just to get the ball rolling as other questions start coming in. So I guess we can start with the fair value. So I'm just kind of curious. You're averaging in a position, and you're going to be looking for trying to get your size on around fair value.
Correct.
But what about targets? So would you be, I mean, like, let's suppose, and time frames too.
Yeah.
Maybe you can give a little bit of insight on both of those. Like, how long are you holding for? Basically, it sounds like the most important thing here is you want to get your size on.
Exactly.
And you're looking for just how can you get into the market without getting slipped?
Exactly. It's a fair price level, and you can see very quickly if you really miss these points, you pay too much. Yeah? If the market starts to run in one direction, it's very difficult to enter. If you want to enter with 100, 200 lots, you're moving the market by a couple of points. Yeah? And the ES is still very okay, but if you trade the Nasdaq or so, you really can get problems if you trade 100 or more lots. So this is why I first want to spot the points that can give me a fair value for an entry. So I know the market will also be quiet. And then I have a prediction. Where should the market go according to my analysis? Am I thinking that we are now to bottom, or are we going higher? What we can basically say, if I check here the ES sometimes on the Forex markets, okay, it's looking now a little bit messy. I'm trying to divide the markets here on a longer time frame. This is now a daily chart. Let's move here to a 1 hour chart, into this sort of rotations that we have, sideways ranges. In this sideways ranges, we know position size was built up, and the point of control is basically sort of the price that the people that they used for buying and selling. So where buyers and sellers met. So, and then later on, the market is basically being put into another direction out of this range. If everyone says, okay, business is done for us, we are going to move the market into one direction. And then basically we know that we have a trend. There are now two certain things. If the market breaks through the low, I can basically already start to sell my positions if I believe the market goes into the short direction, or I'm waiting for a retest, in this case to the point of control. Okay, this is not the best example, but for me, I want to see where are all these sort of ranges. Again here, we are now at the all-time highs, but also here we have a range. We also have this high volume nodes. I know if the market, for example, comes back to this level. I know many people were actually buying. We have a retest, and this is then also fair value, fair level, where I know people are going into the market to continue buying, defending their position size, where I also can get, where I can expect a high volume to basically continue the trend. If we are now in a trend, we always have this level of breakouts or retests. Here, market is breaking out, coming back because we know a lot of volume came here. And then if I enter the market here, basically the market is continuing. These are simple retest levels, or simply the VWAP on a longer time frame. We know if the market is coming back to the anchored VWAP here, the probability is very high that the market is going to test it. Volume is coming into the market, and then I can get more or less a fair value price because most of the algorithms are also entering the market at this level.
Interesting. So what do you think? I mean, you're going over a few different things for determining fair value. You're going over the POC or volume profile. You're going over anchored VWAP. You're going over a VWAP. You're going over TWAP.
Yeah.
So is it kind of a combination, or is it something in specific, or does it matter?
I would say since the computer power came in, actually I started with time price opportunity charts in the 90s, to get actually an idea where is fair value. So the price was determined by time, where fair value is and where a lot of contracts were traded. Simple rule: as long as the price is on one price level, there should be also more trading volume. Then the next thing that actually came up was the volume profile. It became like a static volume profile. With computer power, we had access to the data, so we can actually determine more accurately where is the real volume happening. And then starting with the algorithmic trading, I consider the VWAP and anchored VWAP as a more dynamic volume profile. At the end, it's also price and volume, but it's in a dynamic state. It's adjusting much faster than the traditional volume profile. But if we have, like, let's say, a point of control and a VWAP at the same price level, then we can say this is a good confluence for a trading opportunity.
Yeah. Good to know. So what about Trader Pete is asking about some correlated markets first off, he appreciates your international experience. Are you looking at pre-market correlations in the DAX and the FTSE before the US session, or do correlations not matter to your trading?
For me personally, it doesn't matter. I'm just looking at the ES. If I trade the ES, mostly right now I'm just watching this market.
But you are looking at the VIX, though.
Yeah, VIX, exactly. VIX, but this is not a market for me. That's like a benchmark also for volatility. I mean, you can trade the VIX, but at least the VIX is a measurement for volatility. So
and then how long are you, like, if you're trading some pretty large size, how long are you holding for typically?
Basically can be a couple days, and also intraday, I would say at least, I mean, for me it's long, like 10-15 minutes or 1 hour, a trade like this with a volume size of 100. I think this is a reasonable time frame. Of course, for many traders, this is a very short term time frame, but normally I am trading very short term, as you know, 10 seconds or below 1 minute most of my trades, and I can trade this. So now my conclusion is, if I want to trade like 10 times of this position size, I need at least also 10 or 20 times more of time for one trade.
Interesting. Okay. So how did you ever trade crude oil with size? I mean, that must have been kind of difficult.
I can tell you I traded crude oil with up to 1,000 lots per trade, but that was in 2008, 2007. The market was completely different at that time. There was a complete different order book than now. Now it's very volatile and you cannot trade it like this way. But 15 years ago it was a different market. Now I believe also with this environment right now with Iran and war situation, I wouldn't trade big size in oil. I would stay away.
So I'm wondering, like, what about like your target? So I understand entries
Yeah.
based off of what you have discussed here. I've heard a lot of larger players when they first come to the market, and it's like they've got, like, let's say 1,000 or more contracts to trade. They're first looking for where they're going to get out. And then thinking, okay, now this is where I want to get out. This is, then they may place their limit orders there at that time to be first in line,
Yes.
and and then trade around something like you're saying with fair value to get price to go to their orders.
Yes, definitely. I must have a plan always when I want to get out. Yeah, this is. I only always trade also with take profits and stop loss. There's always a defined exit point for me. This definitely, I totally agree. You want to know when to get out, and then, well, when to get in. But there are also different players who are actually really on the long run. They like in the stock market. Yeah, if you are a company like Berkshire Hathaway or BlackRock, yeah, and you want to enter a market, you want to get a fair price to enter and to stay actually for a longer time frame in that market. This is also going to affect the futures market. If people want to access Nvidia for a long time frame, yeah, or if pension funds entering the market, they basically do not look for exit scenarios. They simply fulfill the order requirements from their customers, and then they try to find a fair price to enter. These are different sort of traders. Also in my company at that time I had my trading plan, but my traders were not paid according to profit. They were paid according to the right entry price. So if they're buying above VWAP, for example, if I wanted to go long, then they didn't get a commission. If they were buying below VWAP price, well, I got a good execution. So there are different players. We are basically the one who is trading for the short-term profit. I consider we are the smallest group of traders there.
Oh, wow. Yeah, we have another bank trader that I think will have some interesting stories about Soros, I recall. But what about hedging? Would you also be looking for, well, I'm in a position already, but I'm going to immediately start to go into another position? I don't know if it's via options or via correlated market or anything like this.
I personally did not do that. I know many traders are trading through ETFs like SPY, yeah, to hedge markets or certain stocks. Actually, they're using the futures market as a hedge for their stock positions, for example. I'm personally not doing that, or I didn't do that. For me, basically, I want to get in and I want to get out because I'm a trader. If you have no interest in a longer position in a stock like Nvidia or whatever, and you still want to gain control with your voting rights and so on, you have a different intention of owning that stock. So then you don't want to sell the stock. But for me, I'm purely in for the profit. Yeah.
I see. So another question, I will get to, keep the questions coming in, guys. I will get to them. I just had a list here that I thought I would start with Robert. And based on some of the things that you said earlier about using icebergs or hidden orders, I'm kind of curious how you are getting filled. Were you using mostly iceberg orders, limit orders, and maybe smaller market orders to kind of get a full position on, or was it something just exclusively like icebergs or limits?
No, in China, basically, we had over 300 accounts from 300 different people that we were using for trading. And each account was executing the small trades from our trading desk. First of all, it was to, well, not let people know that you're actually entering the position, especially the government, because a lot of was insider information that we actually had, that we were buying. And so we used dozens of accounts, yeah. And every trader managed like 10 accounts where they were always buying like a couple hundred or couple thousand stocks, depending on. So we diversified this. And well, basically this was quite common also in Hong Kong. And I know many of my friends that was purely their own trading desk. They were just receiving larger orders from banks or private traders, and they were basically spreading these orders through hundreds of different accounts. So nobody can trace it back to you. This is the way how we did it. And then we simply tried to find we did the opposite of what was the common knowledge. Other friends, they owned newspapers, they owned chart analyst letters and so on, and people were actually following this news. So when they gave a buy order, basically we were selling. Common way of how to actually get size into your company. And then, of course, we knew what is going to happen with the company, and that created a certain niche for us to actually let our profits run there, and also to prepare ourselves for the exit scenario.
I see. So, so that was in cahoots with the news agencies to be able to get some size on, or you would just wait and hear what they had to say, and then here's your opportunity to enter the trade because they're saying sell and you will be buying.
Basically, you pay for the news, and they get their profit share. It is a closed game.
Yeah, that's that sounds fair and objective.
Yeah, it's the truth. In smaller markets, you can do it, but I mean, if you're in Germany, you know the topics about the Volksaktie, German Telekom stock. It's all official news. Yeah. One of the biggest scandals was the organization to protect the small investors. Yeah, the head of them actually did all the insider business. Yeah, it's still working like that. I mean, banks and analysts, they are not supposed to work together under the same roof. But if you have a big client who wants to buy something, you first get a sell analysis. Yeah.
No. Wow. What about you mentioned something earlier too that I wanted to follow up on, which was the retail traders, like a moving average crossover or bounce off of a moving average, a popular moving average, or a floor trader pivot or something. And when those start to kick off, would you get an alert or something? How would you be tracking those strategies from retail traders to take the opposite side of the trade?
I mean, just look at TradingView, for example. There are so many scripts and trading bots that you can basically use. And you know what most of the people are looking at. I mean, you can research this moving average, RSI, MACD, and then if you look for a special market and you get this sort of signal, yeah, you simply do the opposite. I mean, most of the traders, they are not that fast as we do here right now. Yeah, we really have to say this. I mean, with Bookmap, you are at the source of speed. Yeah, but we are the exception of the traders. So if somebody is looking at a MACD cross signal or whatever, he still needs a lot of time to actually execute a trade, and that time gives an advantage for us.
Yeah, I see. Just because he has to fumble for execution.
Yeah, probably he has to take out his trading app to place the order or to review it, or he's still working. Yeah, I mean, these are not 24/7 traders.
So you wait. You put your orders in and you provide liquidity.
Yeah.
Wow. And waiting for that for them to kind of start to trade and take the opposite side of your trade.
Correct. At least we can see. I mean, volume is coming in, buying pressure is coming in, and then you can easily go on the other side.
Yeah.
Wow. Especially the stock market, it's much easier and slower than in futures markets. Futures market is completely different, a lot faster. I prefer the fast market. Yeah, but if you really want to focus on these reverse strategies, look at stocks. It's easier.
What about stop runs and there's a couple of different things maybe to cover here, like not only stop runs like what just is unfolding right now, but because retail traders, for example, when it comes to stop runs, we all think that they're out to get us and run our stops, and maybe address that question as well as the distinction between market makers, because you're not a market maker.
No.
And there's a lot of confusion around that. Maybe it would be great to get it kind of squared away here.
Yeah. For me, stop runs basically, I mean, we can see it here. The market took the low, yeah. And if I know this, I can already see liquidities here. I would simply place a buy limit order below here, somewhere here. Just depends on my size, but I assume that we have this sort of, I predicted, yeah, that we have this market sweep. And then if I place my buy limit order here, for example, the market immediately runs into my position. And the possibility that the market is going to turn is very high, yeah. It is quite simple. Also, very nice to see sometimes with news release. If we have a news release, we have, let's say, 8:30 Eastern time, when the important news, most likely the market is jumping 20 points to the upside or 20 points to the downside if there are some sort of differences from the news that are unexpected. And you simply place a sell limit order above and a buy limit order below, because the market is moving so fast that we have an imbalance in the order book. And that is basically not allowed according to the rules and regulations of the CME. So the price will basically come back to sender. Yeah, this is what it's always doing. And then you get yourself stopped in and have already your take profit here, and you take like 10 or 15 points in the ES within 1 or 2 seconds. Well, similar is for me for stop runs. If I see something like this, I place my buy limit order according to my size, basically below here. If I get stopped in, the market is going into my direction, and I would probably already now I would be break even, yeah, or even start to sell already my positions. I think what people are going to do here already here on this level 8, 9.
Yeah, it looks like it. How much size can you get on for like a news event or a stop run like this?
Stop run like this, I think this is easy. Now we have here triple digit order book. I think 400-500 lots is possible. Yeah. We see Iceberg Orders 775, 432, 640 from the stop run. Depends on how long you want to keep the trade, but I think 400-500 contracts is not the problem. If you also look into that, there are 77, 39, 63. Oh, it's difficult to say. 100. 125. There are already couple orders here.
Yeah. So let's see. I just had one more question, but then we'll get to everyone here. If you could just kind of maybe clarify the distinction between market makers and their job and what they're doing and what you are doing as an institutional trader.
What the market maker is doing, the market maker is basically getting paid by providing liquidity. Yeah. So if more orders they have in the market, they're getting somehow a commission from that. Yeah. So they have a different objection in making money. Their point is to provide liquidity. That's the job of a market maker. Small liquidity, as more orders they provide, as more money they become. For me as a trader, I'm simply looking to buy cheap and sell high. Yeah. So we are different positions. For me, as the market makers, I know simply make money by providing liquidity and reducing their risk. For example, especially if you're here in Europe, we have a lot of CFDs. They're all market makers, and they're just looking at their risk exposure, but mostly only on making money by the spread. That's it.
Yeah. Yeah, so, that makes sense.
So we're in a different business.
Let's see. I think it's important to there's a lot of confusion that you hear about it. Everyone referring to the market maker, this and that, and we always kind of say that no, like the market making is a very different job, and they're doing something very different than what you are doing as an institutional trader. One more question is how would you, if things really go haywire, bad against you, Let's
Yeah.
suppose you had your 400 lot on right now.
Yeah.
And how would you exit if you had to, the quickest way to exit?
Flatten.
What is that?
Flatten or the flatten button on the bookmap to get out as quick as possible, and all orders are cancelled, and simply takes a loss. Yeah.
So I mean, as an institution, though, they are hitting the market sell button, or are they? I mean, we see algos chasing
Yeah.
the market all the time,
Yeah.
and yeah, they're getting maybe some size on, but they certainly. I always kind of wonder if they would have slipped the book that much against them, or they got a horrible fill by chasing in the algo. But yeah, any kind of insight that you have.
Basically, mostly they have risk systems, yeah. And if you reach a certain risk level, yeah, you will get notifications that you either start to liquidate or that the system will automatically liquidate for you. And in my company or on most of the other companies that actually still survive, they have the black swan model. Yeah, what can happen in the worst case? For me, the black swan model was always okay. We have September 9/11, the market closed and opened 10% later, 1 week, to the Dow Jones. Can I survive this moment? Yeah, or am I bankrupt afterwards? So if you can estimate this black swan model for you, and then simply I do not, for my risk management, yeah, if now 400 contracts run into straight against me and I know it could ruin me, I would never trade 400. So if I have this complete haywire scenario, I simply click flatten and I'm out. Then I probably have a bad day where I made maybe 5% or 10% loss on my capital, but I'm still in the game tomorrow. So there's somewhere only one rule that is simply for me: get out as quick as possible and just take it.
Yeah, yeah, makes sense. Let's get to some of the other questions here. We've already answered a bunch of them along the way here. But Dr. Phil has a few questions in here. There's a lot of trade just before the liquidity zones. Can you consistently win by joining the liquidity price or get or better just inside or outside? I don't know if I quite understand the question, but I think kind of front running maybe some of the high liquidity.
Probably, let's assume, if I understand it correctly, we have this zone as liquidity here. And now I could place a sell limit order just one tick before. Yeah. So most of the time the market does not take the liquidity the first time. So the market will probably turn around before, and I have a pullback of like 10 ticks or so. I can use this as a trading strategy. But the first thing, same like here, maybe buy before this liquidity. The thing that you always have to consider: are we in a trending market or in a range market? If we are in a trending market, liquidity is always the target, so the market is going further in that direction. In a sideways market like this, for example, this might be the support and resistance zones. But for me, I basically like to see if we have a standard deviation here and we have the liquidity as a resistance zone. Yeah? Because the algorithms are focusing, my point of view, a little bit more on the standard deviations or on the anchored VWAPs or VWAPs than on liquidity. Since the order book is also so messed up, yeah, we have to say it. That was a valid trading strategy last year. I traded a lot, just front running before the liquidity. Yeah, it was working quite well. But since we have this auto spreader, it became definitely more difficult. And the market is definitely more choppy. Now I would not put myself in front. I would myself probably behind the liquidity, yeah, because we always have this sweeps because of this thin order book. So these are things that we have to detect every day new before I start trading. I want to get the feeling for the market. Are we in a choppy market? Are we in a sideways market? And how does the market react on certain indicators for me, like benchmarks like the VWAP? And according to this, I place my orders and also determine my trading size. Also, this is very important. If you follow my trading group, you can see at the moment I'm only trading like 1 or 2 lots. Yeah, but that's on multiple prop firm accounts, and everyone who's following this prop firm industry right now, they know that they're going to get problem with the CME, or there are already issues with the CME, and sooner or later most of the prop firms will disappear because the CME actually wants to bring trader live to the marketplace, which is absolutely reasonable because then the CME makes money through commission. But if you're a prop firm company and you only provide sim mode to the traders, you're not bringing liquidity. And that means the CME is not making any profits, or not much, just by selling the data. And there will be a change of rules that the prop firms that are existing right now must bring people to live trading. And then if you trade like 20 accounts with Apex, and each account you trade 3 or 4 lots, you trade 60, 70, 80, or easily 100 lots. And then this topic, what we are discussing right now, becomes essential in the future. If more people are trading multiple accounts on the futures market, I'm interested how this is going to develop on the real trading environment. And well, otherwise, most of the prop firms are going to disappear within the next 6 or 12 months. But the ones who are there, they're going to put you live. Since I'm already on probation mode. I don't know when they're going to change this to live trading, or if they kick me out. This can also be after so many payouts. I have no idea yet. So some sort of Damocles sword above my head. Just the information, more will go live soon. Yeah. So this will change the market and the trading.
Yeah, it's really interesting. I mean, because a lot of the prop firms right now, there's no commissions as well, and they're getting these incredible fills, and that's just not going to happen, like you're saying.
Exactly, there will be a big change in the way we are trading, and especially for the people who trade multiple accounts, then they really have to face the real liquidity issue, and they have to get used to it. Yeah, or most of them are going to die. But if they are the traders, if they're going to die, the prop firm is also going to die. They probably know this problem.
Let's see. Mr. Nolok has a few questions in here, some good questions. So what is the lowest time frame you look at for entries in terms of chart, or do you purely focus on order flow and Bookmap for entries, or higher time frame locations?
Basically, I start with the traditional top to bottom analysis. I'm checking daily chart, hourly chart, 15-minute charts. But for day trading, I'm using a Bookmap as a tick chart and a 1-minute chart on TradingView or Quantower. This gives me the best overview.
Okay, and he's got another one here, a few more actually. So can we confirm with what you just said, now institutions always look to trade toward VWAP rather than away? There's one question.
Okay, for me, do not think about how they trade. Just think about this way, that VWAPs is a benchmark and that algorithms are going to act when they come near VWAP. This can either be on the buy side or on the sell side. But what we know is something is going to happen. And this something is always creating certain movements, pullbacks at the VWAP. Yeah? Always very short-term pullbacks. They're done within a couple of seconds or below 10 seconds most of the time. And this is something what I'm using for my personal trading, in day trading. This is how I see it. Simply,
I see.
Something is going to happen from the algorithm trading side.
So Mr. No Luck is also inquiring about, you mentioned that you don't really look at market correlations, but what about spread trades? Do you do any of that? Like, NQ, ES, RTY, whatever?
No, also not, no. My niche is simply realizing and knowing when are algorithms going to buy and sell. This is what I'm looking at.
Yeah, okay. Great. Let's see. Rezo has a question here. When someone is selling, for example, 500 lots at +3 standard deviation, why should someone else buy it when it's top expensive?
Well, the question is, what is expensive in your time frame? If you are now a pension fund and you want to invest for the next 6 months, maybe that is a cheap price. Yeah, look at Nvidia 6 months ago and now. So everyone thought probably it was expensive, but it's now more expensive. So we do not know there's so many different players, yeah. We don't know what is their intention. And maybe if somebody wants to buy, or maybe he's going short, we also don't know that. He's just taking the opposite position. But how does it look on his personal account? We don't know. Or is this simply a trader who has to execute an order from a bank or a pension fund or ETFs that are going to invest in the markets, and every month people are paying money into ETFs, and then they simply have to be forwarded to the real market. Yeah, doesn't matter at which price. So we don't know who's the other side. So we cannot think about if this is expensive or not. Maybe in my point of view, it's expensive. Yeah, I wouldn't take this trade. But for me, I'm also out after 5 seconds or 10 seconds. So then the game is over for me. And then someone else is coming to take the trade.
Right, right. And then Dr. Phil is asking more again here about what about like at extremes like overnight lows, or recent highs, or things like this. And do you look at those areas just in terms of you will look for maybe like right now maybe a stop run through that area?
Yeah.
Okay.
These are very nice scenarios for stop runs and so on to actually get a good price. Yeah, these areas are being tested.
And so you're looking at liquidity at those levels, and then like you see like 778 stops. I mean, that's huge. So so you would be going, okay, this is great. I'm buying. I'm getting in here. Okay.
And I would say in situations like now, I would place my buy limit order below that liquidity. Yeah, we can see the sweeps, and then if I would enter here right now, probably for me personally, I would lose too much money already. But that always depends on your trading period. If you probably want to hold this trade for an hour or two, maybe we see prices above here. But for me, I want to get in around here, because right now it happens most of this. So why should I waste this 1 or 2 points?
Yeah, yeah. So Kenobi's asking about your risk reward that you use in your trading when you're trading size.
If I day trade, mostly it's like 1-to-1 at the moment. Yeah. But I have a hit rate of 70 to 75%. And well, I'm using trailing stop loss also, so I basically very seldom actually reach my stop loss. If I would narrow it down, at the moment it's like 1-to-1.
Okay. So you will place a stop, but you'll just exit before the stop is hit if you don't like it.
It's already being done automatically here with TradingView. There's the trailing stop loss. The order is already or the stop loss is being increased or decreased in that way.
I see. Okay. Wow. This is fantastic, Robert. We should be doing this all the time with you.
Welcome.
Yeah. Thank you so much. Really, really great viewpoints here that are it's very uncommon and very, very insightful. And everybody, we have this competition now coming up. So I think you're really going to enjoy some of these ideas in here and put them to use that Robert is talking about here. Let me see. We'll end here with one more by Mr. Noluk. Hedge funds are said to trade no more than 6% of total capital. He's been told. Yeah, Apex is already under fire. Top Step, yeah, and Top Step X.
There's a own platform for them. Yeah. Well, hedge funds don't have rules. There is no. This must be a hedge fund. You can also set up a company, trade the money, then you're a hedge fund. Yeah. You really have to know, if you invest in a hedge fund, who are the players, who's the manager of that fund, and then of course you have to trust them. Yeah. I mean, they can do anything. There are no rules and regulations in the hedge fund industry. It's like that.
Yeah. Wow. Well, let's see. I think we've gone through over an hour now and answered all the questions in here. A lot of appreciation coming through in the stream here. Thank you so much, Robert. Any last parting words here? And I know you stream with us and you're going through your VWAP strategies with everybody. That's what something. There was a question here from Alan, but Alan, I'll just point you to go to those streams and ask those questions there, since that's smaller size than what we're talking about here. So yeah, any last words, Robert, and we'll wrap it up.
Well, basically, simply get the experience to trade with the trading competition with larger lot size and see how your trading will actually change or not. What executions are you to get a feeling for it, to see how it works. Just experience it. I mean, you have nothing to lose. That's what you can do.
Exactly. Wow. Thank you so much, Robert.
You're welcome.
Okay. We'll meet everybody tomorrow for continue on with the series. And yeah, thanks for coming. And yeah, thank you again very much, Robert.
Thank you too. Have a nice day. Bye.
Bye-bye.